Welcome to the daily stock Beaver market briefing. Today is July 30, 2026, and we're going to dive straight into the market snapshot. The Nasdaq surged 2.78% as Microsoft's bullish cloud forecast reignited the AI trade, lifting semiconductors 8.5%. Gold climbed past $4,160 an ounce, up more than 3% on a weakening dollar. And one day after the Federal Reserve held rates steady, the 10-year Treasury yield sits at 4.67%. Bond investors are sending a message of their own. The big story today is a collision of forces. Microsoft's cloud growth forecast sent its shares soaring more than 16% in a single session, pulling the entire semiconductor complex higher. The semiconductor ETF SOXX rose 8.5%. That rally powered the Nasdaq up 2.78% and the S&P 500 up 1.66%. But beneath the surface, the bond market is pushing back hard against yesterday's Federal Reserve decision to hold rates unchanged. The 10-year Treasury yield has climbed from 3.95% at the end of February to 4.67% today. Mortgage rates hit a one-year high of 6.66%. Core PCE inflation still runs at 3.3% year over year. Meanwhile, the dollar has fallen 1.45% this week. Crude oil has dropped nearly 9% over the same stretch, and gold is surging. We'll break down what the precious metals rally and oil's slide mean for inflation, and we'll examine the Fed's credibility problem later in the show. Earnings season added another layer. Meta posted quarterly revenue of $60.8 billion, up 28% year over year, but operating income fell 8% as legal charges and severance costs weighed on results. Free cash flow was just $784 million as AI capital expenditures topped $31 billion in a single quarter. Qualcomm delivered a mixed picture. Automotive revenue surged 61%, but management warned that soaring memory prices and supply chain shortages are squeezing gross margins. Boeing delivered 171 aircraft, its highest quarterly total since 2018, and cut debt by $1.3 billion. UPS raised its full-year outlook after completing its Amazon volume reset, with U.S. revenue per piece up 9.3%. And Visa crossed $4 trillion in quarterly payments volume for the first time, with pricing as an explicit driver across multiple revenue lines. What stands out today is divergence. The Nasdaq is up nearly 3% on AI optimism, yet gold is up more than 3% and the dollar sits at multi-week lows. Investors are simultaneously chasing growth and hedging against the inflation the Fed cannot contain. The numbers at the close: S&P 500 at 7437, up 1.66%. Nasdaq at 25,122, up 2.78%. The Dow at 52,208, up 1.19%. And the Russell 2000 at 2946, up 1.37%. The VIX Fear Index sits at 17.9, moderate, signaling calm without erasing the anxiety that has defined July. We remain in a neutral market regime. Long-term treasuries, tracked by TLT, slipped 0.6%. The 10-year yield holds at 4.67%, up 6 basis points today. The national debt stands near $39.8 trillion, up roughly $2.5 billion today. We'll go deep on the federal budget later in the podcast. Gold is at $4,160, up more than 3%. Silver rose to $59, up nearly 2%. We'll go much deeper on precious metals coming up next. Oil holds at $83.93. And Bitcoin trades near $64,700, up 1.3%. Looking at the sector map, 9 sectors finished green and 5 closed red, but the real story is the magnitude of that split. Semiconductors dominated, surging 8.5%, as Microsoft's cloud growth forecast rippled through the entire chip supply chain. Technology overall gained nearly 5%, and international stocks rose 2.89%, boosted by a weakening dollar that makes overseas revenue more valuable in translation. What's striking is the defensive sell-off on the other side. Consumer staples fell 2%. Healthcare dropped 1.34%. Communications fell 2.73%. When investors dump staples and healthcare, the traditional safe havens, to pile into semiconductors, it signals a sharp shift in risk appetite. Utilities and real estate also dipped, which makes sense given the 10-year yield at 4.67% and the 30-year crossing 5.2%. Those rate-sensitive sectors feel every basis point. Energy managed a small gain despite oil's near 9% weekly slide, a sign the market is looking past near-term weakness toward Middle East supply risks. Weekend review. This was a rotation week disguised as a flat one. The S&P 500 gained just 0.39%, and the Nasdaq finished essentially flat at minus 0.6%. Those calm headlines conceal one of the more dramatic sector rotations we've seen this year, and the year-to-date leaderboard has a surprise guest. The Russell 2000 is up 17.46%, nearly double the S&P's 8.44%. Small caps are quietly outpacing the megacap trade that dominated the first half. The starkest divergence sits in semiconductors. The SOXX semiconductor ETF fell 8.47% this week, the worst-performing sector by a mile, despite being up nearly 61% year-to-date. Today's session brought a powerful reversal on Microsoft's bullish cloud forecast, but that rally only partially offset a punishing 5-day stretch. The mirror image is software. The IGV software ETF jumped 7.13% this week, the best sector return, yet it remains down 9% on the year. When money flows out of the year's biggest winner into one of its biggest laggards in the same week, that's institutional investors trimming extended positions and hunting for value. That divergence, chips down hard, software up sharp, is the chart that tells you the AI trade is broadening, not breaking. The rotation extended beyond tech. Consumer discretionary gained about 3%, supported by O'Reilly Automotive's second quarter results, and consumer staples rose 2.8%, helped by Hershey's earnings. On the losing side, utilities dropped 3.4%. That's predictable when the 30-year Treasury yield sits above 5.2%, and income investors can find competitive returns in bonds without equity risk. Why own a utility when the government pays you more to wait? Energy slipped about 1% even as crude oil's weekly plunge approached 9%. A signal equity investors haven't fully abandoned energy stocks despite the commodity sell-off. The cross-asset signal is where this week's true message lies. Gold rallied 2.7% while the dollar fell 1.45%. That's the textbook relationship, since a weaker dollar makes gold cheaper for overseas buyers. But the bigger tell is crude oil collapsing nearly 9% in the same week. When gold rises while oil plummets, you're seeing two forces at once. Safe haven demand accelerating even as traders unwind the geopolitical risk premium built up during peak Iran conflict fears. The market is saying, we still want protection, we just don't believe the supply shock lasts. What's notably absent is Bitcoin. It moved just 0.65% this week and remains down 27% year-to-date, completely divorced from both the AI equity rally and the precious metals bid. For anyone who expected crypto to serve as a portfolio diversifier in times of stress, that 27% year-to-date loss while gold recovers and stocks grind higher is the disconnect worth marking. 30-year Treasury bonds slipped 0.2% on the week, consistent with long-end yields pushing higher in open defiance of the Fed's Wednesday decision to hold rates steady. When long bonds fall after the Fed pauses, the bond market is telling you it doesn't trust the pause. The verdict: this week did not extend the year-to-date momentum story, it complicated it. Semiconductors, the engine of the index gains, showed they can fall hard even in a flat market. The rotation into software and consumer names suggests smart money is quietly diversifying away from a single trade. And the cross-asset picture, weaker dollar, stronger gold, plunging oil, points to growing skepticism about the Fed's inflation fight. The question for next week is whether today's chip rally has staying power, and whether gold can extend its run if the dollar keeps sliding. Now let's dig into the commodities complex, starting with energy. Commodities. The dominant story is a collision between an energy shock that's fading and a precious metals bid that's accelerating. Year-to-date, heating oil futures are up 95% and wholesale gasoline has climbed 84%. Those are wartime price moves, the kind of percentage gains you normally see during active supply disruptions, not peacetime trading. Crude oil has gained nearly 47% year-to-date, but this past week told a very different story. Crude fell 8.7% and Brent plunged more than 13%. The market is now deciding whether supply disruptions from the Iran conflict are permanent or transitory. Wheat futures, up 42% year-to-date, round out the picture. That's not an energy story, that's a global food supply story, and it's the one most likely to show up at your grocery store with a lag. Energy's weekly sell-off might seem at odds with headlines about drone strikes on Russian refineries, including the Ryazan plant which halted processing on July 29, and security threats near the Suez Canal. But futures markets look forward, not backward. WTI crude settled near $84 a barrel, down less than 1% today, but off nearly 9% on the week. Brent's weekly decline was even steeper at over 13%. Wholesale gasoline futures fell nearly 8% today alone, bringing the weekly loss past 10%. These are futures prices, not what you pay at the pump, but they tend to lead retail gas prices by a few weeks, which means the relief at the pump, if it comes, is still 2 to 3 weeks out. The EIA's weekly petroleum status report adds crucial context. Crude inventories drew 3.8 million barrels to roughly 308 million. Supply is genuinely tightening, but the real warning sign is gasoline. Stocks were dead flat at 211 million barrels despite peak summer driving season. Refiners are running hard, yet product isn't building. That means demand is absorbing everything they produce, or exports are pulling it offshore. Either way, the physical market is tighter than the future sell-off suggests. Our internal positioning data reveals a striking split between speculators and the people who actually drill the oil. Big traders, that's the hedge funds and CTAs, are only modestly long crude at about 7.5% of open interest, sitting at just the 17th percentile of the past 6 years. That's a cautious stance, not a crowded one, but the real signal comes from producers. Oil companies are barely hedging, with their short positions at the 0.5th percentile, near historic lows. When the people who know the physical market best refuse to lock in forward sales near 6-year lows, they expect higher prices. Meanwhile, gasoline longs are at the 98th percentile, extremely crowded. That gasoline bet is the most asymmetric position in the energy complex, one demand destruction signal away from a sharp unwind. Gold rallied 3.3% today to around $4,170 an ounce, with platinum up 4% and palladium surging 5%. Copper climbed about 3% to near $6.50 a pound, up 14% year-to-date. Copper's strength alongside gold tells you this isn't purely a fear trade. It's inflation hedging, dollar weakness, and genuine industrial demand all converging. Yet despite today's surge, gold is still down about 4% year-to-date. The precious metals rally is recovering lost ground, not extending a bull run, and that distinction matters for what comes next. Gold's positioning says the rally still has fuel. Managed money, the hedge funds, have gold longs at the 87th percentile of the past 6 years, still adding contracts. Gold producers are barely hedging at the 3rd percentile. Miners expect higher prices ahead, and when the people who pull the metal out of the ground won't sell it forward, that's a powerful conviction signal. Silver is the surprise. Despite the bullish label, speculative positioning sits at just the 7th percentile. Almost no one is positioned for a silver rally, which means there's enormous room for catch-up if gold extends its run. The danger spot is palladium, flagged high risk. It's the most crowded bearish bet we track in metals, and crowded bearish bets in tight markets are exactly where short squeezes originate. Agricultural futures were mostly lower this week. Orange juice jumped 6.2% today, but wheat pulled back about 4% on the week while remaining up 42% year-to-date. That 42% move traces to global supply disruptions, and it will eventually pressure bread and pasta prices with a lag. For consumers, the persistence of these year-to-date increases means food inflation pressure hasn't gone away, even if the weekly direction was down. The weekly dip is a breather, not a trend change. Smart money is rebuilding grain bets aggressively. Big traders added nearly 50,000 long contracts in corn and over 52,000 in soybeans, positioning for whether risk or inflation pass through from energy costs into fertilizer and transport. Wheat shorts are beginning to cover, with positive velocity of about 17,000 contracts despite the bearish label. When shorts start buying back into a downtrend, momentum is shifting. The standout risk is sugar, where traders are short at the 90th percentile. One favorable crop report from Brazil could spark a squeeze, and when a short position is that crowded in a commodity with weather risk, the asymmetry favors the upside. Now let's see how the dollar is holding up against the world's major currencies. Currencies. The dollar is under siege this week, and the catalyst is the Federal Reserve's decision to hold rates steady, read as a policy failure by currency traders. The dollar index fell 1.45% to just below 100. That round number breach matters psychologically. 100 is where support has held all year, and closing below it puts the dollar's year-to-date gain of just 1.65% on very thin ice. The Japanese yen is the most dramatic mover, surging 2.4% today and 2.6% this week, with the dollar plunging below 160 yen on suspected Bank of Japan intervention. Hedge funds have been massively short the yen, 37.6% short, at the 91st percentile of 6 years, betting the rate gap between the US and Japan would keep widening. That crowded trade is unwinding fast, and when the 91st percentile short starts covering all at once, the velocity of the reversal can be violent. The British pound strengthened about 1.1% this week after the Bank of England delivered a hawkish hold, signaling rates may stay higher for longer. The pound is essentially flat year to date against the dollar, remarkable resilience given the greenback's broader strength, and a signal that the market differentiates between central banks that inspire confidence and those that don't. In emerging markets, the Korean won rallied 3.5% this week. Though it's down nearly 8% over the past month, that weekly strength looks like short covering in a downtrend, not a true reversal. The Brazilian real has strengthened 7.6% year-to-date, fueled by commodity exports and aggressive central bank tightening. A reminder that the countries that raised rates earliest and most aggressively are now reaping the currency reward. The Turkish lira continues its structural decline, with the dollar up 10.3% against it year-to-date, which is what happens when monetary credibility is absent. Our positioning data reveals extreme anti-dollar bets across the board and a sharp disagreement about what comes next. Leveraged funds have euro shorts at the 99.5th percentile, the most crowded bet against the euro in 6 years of data. Canadian dollar shorts sit at the 98th percentile. These are conviction-level bets that the dollar keeps rallying. But asset managers, the pension funds and endowments with longer horizons, actually hold the dollar long at 40% versus just 3% short. When leveraged funds and institutional money disagree this strongly, something has to give. If the Fed signals a pivot, those extreme shorts will be forced to cover, and the euro could snap higher with enormous force. For American listeners, the practical impact is straightforward. Your dollar still buys slightly more in Europe and Canada than it did in January, since the dollar gained nearly 2% against both the euro and the Canadian loonie this year. But that edge is shrinking fast after this week's sell-off. If you're planning a fall trip abroad, consider locking in your currency exchanges soon. The bottom line: the dollar's fate now hinges on whether the Fed can restore its inflation-fighting credibility, and that brings us directly to the bond market's verdict. Treasury and Rates. The yield curve is telling a story of distrust in the Federal Reserve. The 10-year Treasury sits at 4.67%, up 6 basis points on the day, while the 2-year holds at 4.22%. The 45 basis point spread means the curve is positively sloped, not the recession warning inversion that preceded past downturns. But it's steepening for an unhealthy reason. Short-term rates are drifting lower as traders price in potential Fed caution, while long-term rates climb because bond investors don't believe Chairman Warsh has inflation under control. The 10-year yield has climbed from about 3.95% in February to 4.67% now, a punishing repricing of more than 70 basis points in 5 months. With Core PCE still running at 3.3% year-over-year, the bond market is effectively doing the Fed's tightening for them, and long-end investors are demanding compensation for inflation they no longer trust the Fed to contain. For retirees and savers, this is finally a real income environment. A 4.22% 2-year Treasury means certificates of deposit and money market funds are paying meaningfully again. But for borrowers, the math has changed. Freddie Mac data showed 30-year mortgage rates hitting a 1-year high of 6.66% this week, the 4th straight weekly increase. When mortgage rates rise 4 weeks in a row while the Fed is on pause, the bond market, not the FOMC, is setting your borrowing costs. Treasury trading volume reached roughly $1.46 trillion on July 29, with dealer customer flow at 46%. That matters because it means real money accounts at pension funds and insurance companies are actively repositioning, not just dealers passing paper between themselves. This sell-off has conviction behind it, concentrated in the intermediate part of the curve where the rate debate is loudest. Our internal positioning shows the Treasury short is massive and systematic. Hedge funds are 43.8% short the 2-year and 36.8% short the 10-year, sitting at the 84th percentile of 6 years. That's a big bet that rates keep climbing, but velocity is turning positive across the curve. Funds added about 81,000 contracts covering 2-year shorts last week and 34,000 on the 5-year. When a position at the 84th percentile starts covering, it means even the bears are getting nervous. Dealer shorts remain extreme at the 98th percentile on the 2-year, but the covering has begun. If any data point confirms a Fed pivot, remaining shorts could be squeezed violently, and an 84th percentile short unwinding into a dovish surprise is the kind of move that reprices the entire curve in days. In equity futures, hedge funds remain net short the S&P 500 at 16.7%, but they're buying back with positive velocity of about 44,000 contracts. Translation: they're still bearish, but less bearish every week, and the rate of covering tells you conviction is fading faster than the position. The VIX long sits at the 99.5th percentile, meaning professional money is carrying extreme tail risk protection. They don't trust this rally. That VIX position is the loudest risk management signal in the system. When hedge funds are near record long volatility while buying back equity shorts, they're hedging against a specific downside scenario, not abandoning the market. Bitcoin futures are flagged high risk at 57.8% short, the most dangerous squeeze candidate in our entire system, alongside palladium. Stepping back across everything we've covered today, the positioning tells a unified story. Every crowded trade points the same direction: anti-dollar, anti-bond, pro-hard asset. Producers who know their markets best are refusing to hedge oil at the 0.5th percentile, gold at the 3rd, confirming physical tightness is real, not speculative. FINRA data adds another layer of concern. Margin debt hit roughly $1.5 trillion in June, up 49% year over year. That kind of leverage growth means investors are borrowing to stay invested, which amplifies any correction. Corporate bond breadth deteriorated with declines outpacing advances by more than 2-to-1 late-cycle leverage meeting early credit stress. Our stock Beaver positioning analysis as of July 21 shows the big money is positioned for stagflation, a weaker dollar, higher commodity prices, and persistent inflation. But danger is concentrated in 3 places. Extreme euro and Canadian dollar shorts at the 98th plus percentile could reverse violently on any Fed pivot signal. Gasoline longs at the 98th percentile are one demand shock from unwinding. And Bitcoin and palladium shorts are the 2 most asymmetric squeeze candidates we track. If you hold significant commodity exposure, consider trimming some gains. Now let's pull back to the bigger economic picture: what the Fed is doing, how jobs are holding up, and where the economy goes from here. Economy and the Fed. The recession clock reads 31.5 out of 100. That puts us firmly in the slowdown phase, not contraction. But the leading edge is clearly rolling over. 2 components drive that verdict. Building permits are down 1.8% year over year. Housing leads the economy by 6 to 12 months. When builders pull back on new permits, they're telling us they don't see demand materializing down the road. Cyclical payrolls, the factory and construction jobs that turn first in a downturn, are barely growing at 0.1%. That's not a freeze, but it is the kind of deceleration that precedes broader hiring slowdowns. The SOM rule, our early warning jobs trigger, sits at 0.17 percentage points, well short of the half-point threshold that has preceded every modern recession. The safety valve hasn't tripped, but pressure is building toward it. And the yield curve has steepened back to normal, with the 10-year minus 3-month spread at positive 0.84%. Historically, that re-steepening after an inversion is itself a recession warning signal. Remember, the GDP and payrolls numbers you hear in headlines only confirm what these leading indicators told us months ago. They lag. They don't forecast. This week's movers tell a story of stress building at the margins. High-yield credit spreads jumped 7% to 2.87%. Lenders demanding more compensation to hold risky debt is one of the earliest market-based signals that investors are repricing default risk. The VIX spiked about 24% during the week before easing in today's session. That midweek surge tells you fear flared and then partially subsided, but it didn't vanish. And initial jobless claims ticked up to 197,000, still low historically, but the direction matters more than the level when you're trying to spot a turning point. Yet the Atlanta Fed's GDP Now tracker still shows positive growth at 1.5% for the current quarter, and overall financial conditions remain loose. The economy is not falling off a cliff, but the stress fractures are widening. The credit market tells the late-cycle story most clearly, and the signal is coming from the bottom. The canary in this coal mine is CCC-rated distressed debt, the riskiest borrowers in the market. Their spreads have widened to 10.13%, up 32 basis points this week alone and 46 over the past month. That pace of widening tells you lenders are getting nervous about the companies most vulnerable to a downturn, even while investment-grade spreads barely budge. Total high-yield spreads sit at 2.87%, still tight by historical standards, meaning the broad market hasn't panicked. But when the bottom tier is chirping this loudly while the top tier stays calm, that divergence is exactly how credit stress typically begins, from the bottom up, before it cascades. The Atlanta Fed's real-time tracker now casts current quarter growth at just 1.5%, down from 1.6% the prior week. That downward revision matters more than the absolute number. When a real-time tracker is consistently shaving tenths off its estimate week after week, it's telling you the incoming data is weaker than what was already baked in. Growth is still positive, but decelerating, exactly what the slowdown phase predicts. The VIX climbed above 20 midweek before retreating to about 17 in today's session. What stands out is where fear concentrated, and where it didn't. Crude oil volatility surged to 68, reflecting genuine energy market whiplash, and the Nasdaq Volatility Index reached 31, telling you tech investors were specifically on edge. But the fact that the broad VIX settled back below 20 means this was selective anxiety, sector-specific stress, not a systemic panic where everything sells off at once. Despite those volatility moves, financial conditions remain very loose. The Chicago Fed's index sits at negative 0.55, and the St. Louis Stress Index reads negative 0.83, both well into calm territory. But dig into the components, and the leverage subindex stands out as the one piece in positive territory at 0.12. Debt levels are the tightest part of the system. When conditions are this loose overall while leading indicators soften, the market hasn't yet priced the slowdown the data is already signaling. That gap between loose conditions and softening data is itself a risk. There's a lot of room for conditions to tighten if sentiment shifts. Initial jobless claims rose to 197,000, up from the prior week's remarkably low 188,000. Claims remain well below the 225,000 level seen in early June. The labor market is cooling gradually, not cracking. The June unemployment rate held at 4.2%, and the broader underemployment rate, the U6, actually ticked down to 7.9%. That stability is real. But the bottom row of this chart is the one to watch. Short-term unemployment, people jobless less than 5 weeks, jumped 31% month over month, while long-term unemployment, 15 weeks and over, fell 8%. That mix tells you layoffs are picking up, but people are still finding new jobs relatively quickly. The labor market is intact, but the momentum is shifting, and the duration breakdown is where the next inflection will show up first. The Fed's balance sheet edged down to $6.74 trillion, a modest weekly decline of about $9 billion that barely makes headlines. But the composition tells the real story. Mortgage-backed securities fell by nearly $14 billion this week alone. That's the steady QT runoff keeping upward pressure on the mortgage rates homebuyers face. Meanwhile, the Treasury General account jumped 16% to $970 billion as the Treasury stockpiled cash. And when the Treasury builds its checking account, it drains liquidity from the banking system. Bank reserve balances fell 2.5% to about $3 trillion, and the reverse repo facility is nearly depleted at just over $1 billion. That RRP facility was the liquidity backstop that smoothed the system through QT. With it effectively exhausted, the Fed has far less room to keep tightening without risking a plumbing problem. FINRA data through June shows margin debt at $1.5 trillion, up 49% year over year. That annual pace matters because historically, when margin debt surges above 30% year over year, it signals investors are building leverage at a rate that has preceded major market tops. The net credit balance sits at negative $1.6 trillion, meaning investors have collectively borrowed well past their cash buffers into negative territory. When you pair that with the tight credit spreads we just saw, the picture is one of broad complacency layered on hidden leverage. For retirees and conservative investors, this matters because leverage amplifies any correction. When margin calls hit, forced selling cascades through the market and turns a pullback into something worse. Here's the identity that makes sense of every rate move you'll hear about. The 5-year Treasury yield is really two things stacked together: the inflation investors expect over that period, called the break-even rate, plus the real, above-inflation return they demand. Add them together and you get the nominal yield. Right now the break-even sits at 2.24% and has barely budged in 3 months. The real yield, however, has been grinding higher. It is the component doing all the work pushing nominal rates up. This tells you the recent sell-off is not an inflation scare. It is the market demanding a higher real return, which is tightening in real terms. For the Fed, this means the market is doing their hawkish work for free. The logical response is to hold, not cut, because cutting into that dynamic would risk unanchoring the very expectations that are currently stable. And for gold investors, a rising real yield raises the opportunity cost of holding a non-yielding asset. Gold's turning point comes when the real rate peaks and rolls over, not while it grinds higher. Because inflation expectations are flat, we just saw the break-even line sitting still at 2.24%. The linkage between oil and Treasury yields is running through the real rate channel, not through inflation expectations. That's an important distinction. When oil pushes yields higher through the real rate rather than through break-evens, the market is treating oil as a growth and tightening signal, not as an inflation driver. Right now, oil's recent slide is being read as a demand concern. Exactly what you'd expect in a slowdown phase where falling commodity prices signal weakening economic activity rather than supply shocks. Taken together, this week's data reinforces the slowdown verdict. Growth is positive but decelerating, labor is cooling but intact, and credit stress is building at the margins, especially in CCC-rated debt. The system is not in distress, but the leading indicators and the credit canary are both pointing the same direction. Now let's see what corporate earnings tell us about the ground truth underneath these macro numbers. Earnings pulse. 3 sectors made the cut this week, and the headline numbers are strikingly consistent. Consumer cyclical leads the pack. 4 of 6 companies beat on earnings, all 6 beat on revenue, 4 raised guidance, and the dominant tone is bullish. Industrials was even cleaner, 6 for 6 on both earnings and revenue. Half the group raised guidance, tone bullish. Basic materials rounds it out, 5 of 6 beat earnings, all 6 beat revenue, and once again the tone is overwhelmingly bullish. Let's break down what executives are actually telling us. Consumer cyclical is the week's top sector performer, up nearly 3%, and the earnings calls confirm that pricing power is the great separator. Ford, ticker F, delivered the clearest price over volume story in the group. Revenue actually fell 4%, yet adjusted EBIT rose 17%. Ford Blue posted higher earnings despite 8% lower wholesales, fewer vehicles sold, but better ones at better prices. Management raised full-year guidance by $1 billion at the midpoint, and as Ford's team put it, they are confident in the pricing power of their pro-business. Contrast that with Smurfit Westrock, ticker SW. CEO Tony Smurfit described market conditions as the tightest he has seen in his lifetime, with containerboard price increases of $100 per ton announced across North America. Yet freight costs ballooned to roughly $300 million year over year, far above the $50 million estimated just 3 months earlier, and EPS missed. The stock dropped more than 6% since the call. The pricing power is genuine, but right now it is being deployed to recover costs, not to expand margins. Chipotle, ticker CMG, was the sector's standout despite a notably cautious tone from management. Transactions accelerated for the second consecutive quarter, value perception hit a 2-year best across all income cohorts, and the stock surged nearly 15%. Restaurant-level margin did contract 220 basis points on beef and labor inflation, but management raised full-year comp guidance anyway, betting that throughput improvements and portion quality will carry the brand through a cautious consumer environment. O'Reilly Auto Parts, ticker ORLY, showed that same SKU inflation of 5.5% flowed through to customers without demand destruction. Professional comps grew about 10% for the 4th straight quarter, but EPS narrowly missed estimates, and shares slipped 3.6%. Hilton and MGM Resorts both posted record quarterly revenue, with Hilton signing its second-largest pipeline in company history. The pattern across this sector is unmistakable. Companies with structural advantages are passing through costs and widening their lead over everyone else. Industrials is the heaviest reporting wave right now, 36 calls in just the past week, and the central question on every one of them is whether pricing power is structural or merely a tactical response to cost inflation. EMCOR Group, ticker EME, is the textbook case of structural power. Remaining performance obligations hit a record $17.1 billion, up 44% year over year, driven overwhelmingly by AI data center demand. Electrical construction margins surged 210 basis points on favorable project mix, and management raised full-year guidance. The stock rocketed more than 19% since the call. Crucially, EMCOR is dictating contract terms to its customers, shifting toward cost-plus structures that protect margins on hyper-complex data center builds. Now contrast that with A.O. Smith, ticker AOS. The company beat on both earnings and revenue, but management described pricing as functional yet defensive. Steel costs rose about 20% year over year, North American margins compressed 100 basis points, and water heater price increases of 4 to 7% were delayed a month just to stay competitive. The stock fell nearly 4%. Management's own characterization was blunt. Pricing power remains intact, but is being used to cover costs rather than to grow margins. Trane Technologies, ticker TT, sits between those two poles but tilts strongly bullish. Enterprise bookings surged 37%, producing a record $12 billion backlog, up 70% year over year. CFO Kuhn described a formal pricing system: negotiate with suppliers first, deploy price only as needed. With demand far outstripping supply, Trane holds implicit pricing leverage even without explicit price hikes, and guidance was raised again. Huntington Ingalls, ticker HII, showed shipbuilding margins climbing steadily on volume and better contract terms, with shares up 14%. Avery Dennison's pricing is shifting from a headwind to a tailwind entering the second half. AB continues its value-based pricing philosophy, with record client retention at 92.1%. The dividing line across this sector is sharp. AI infrastructure and defense backlog give companies like EMCOR and HII genuine pricing leverage. Everyone else is working hard just to hold the line. Basic materials faces the starkest thesis test of all three sectors. When the difference between $0.5 and $2 per pound in input cost determines whether you capture 99% or 60% of revenue as gross margin, Cost structure is not an operational detail. It is the entire investment thesis. Sherwin-Williams, ticker SHW, is the sector winner, up more than 5% since its call. Management raised full-year EPS guidance to $11.80 to $12.20, while explicitly saying they are not betting on a broad demand recovery. An 8% paint stores price increase takes effect September 1, and share gains across all three segments confirm that disciplined pricing is working. Dow, ticker Dow, tells the opposite story. Second quarter net sales surged 20% to $12.1 billion, as polyethylene pricing jumped over 40%. But management guided third quarter EBITDA down to about $1.7 billion on falling prices, and the tone was explicitly cautious. The Q2 surge was a pricing spike that is already reversing as June price settlements average through. The stock dropped nearly 4%. Ecolab, ticker ECL, delivered the sector's boldest pricing claim. Management implemented a global energy surcharge within the quarter, compressing what historically took 2 years of cost recovery into roughly 3 months. Their message to investors was direct. They never give pricing back, meaning once commodity costs stabilize, incremental price flows permanently to margin. Guidance was raised, and shares added nearly 3%. Nucor, ticker NUE, shipped a record 7.1 million tons, with the CEO describing the demand profile as unlike anything he has seen in 30 years. Import penetration has effectively halved, widening the domestic addressable market by roughly 6.5 million tons. PPG and Vulcan Materials both demonstrated aggressive cost recovery. PPG hit 90% inflation coverage in a single quarter, faster than any prior cycle. Yet both stocks sold off around 6%, suggesting the market questions whether these increases are sustainable or merely catching up to costs that have already peaked. Across all three sectors, the beat rates are strong. 15 of 18 companies beat on earnings, all 18 beat on revenue, and the tone is bullish in every group. But the market is discriminating sharply. Companies with structural pricing power, backed by AI demand or irreplaceable assets, are earning double-digit stock moves. Companies where pricing merely keeps pace with costs are being sold. That is the dividing line as we head deeper into 2026. Now let's see how this lands on our top stock and ETF picks. Market technicals. On year-to-date performance, energy stocks are the runaway leader. The energy sector, ticker XLE, is up just over 29% since January. But here is the surprise. The leader is not the most stretched. Your tech funds tracked by XLK are still up nearly 22% on the year, yet their RSI, a momentum gauge where readings above 70 signal overheated, sits at just 42. That tells you tech has been strong all year but is currently taking a breather, not running hot. Breadth is moderate. About 60% of the names in this universe are trading above their 50-day moving average, that short-term trend line that tells you whether most stocks are still climbing. 60% means most stocks are participating, but a sizable chunk is already slipping below the line. On the risk board, the mood is firmly risk-on. Over the past 12 weeks, healthcare, tech, and financials lead the pack, and small caps are right there with them. When small company funds outperform alongside bank stocks, that is money willing to chase the jumpy stuff, not park in safety. The one to flag is financials. Your XLF holdings are sitting more than 7% above their trend line, the most extended of any leader. That is running hard and due for a breath. On the laggard side, your safe haven bonds, the TLT, sit firmly in last place, down nearly 8% on a relative basis over 12 weeks. Nervous money is not hiding anywhere. On sector strength, financials are the most overcooked corner of the market right now, highest score, RSI at 65 and sitting well above their trend line. That move is getting late. Technology is the interesting puzzle. Its recent momentum score has dropped near zero, but its relative score, how it performs versus the S&P 500, is still positive. Translation: tech was a leader that has stalled, not broken. On the flip side, communications and discretionary are the most beaten-down sectors, with communications lagging the market by 16 points this year. Washed out can stay washed out for a while, so do not rush in just because something is down. On investing styles, the clear winner is deep value, with quality stocks right beside it. Both have led for 5 straight weeks. On the opposite side, growth and long bonds are the most washed-out styles on the board. Your growth funds have the weakest relative score of anything here. Now, one style is quietly crossing the middle. Momentum, after weeks out of favor, sits right at the zero line with a slightly positive relative reading. That is often the first whisper of a rotation beginning. Money starting to chase whatever has been working most recently. On overall market health, the technical score sits at about 67 out of 100, squarely neutral. The market is neither overheated nor washed out, and that actually agrees with the price line. Gains are broadening, not narrowing, which is a healthier foundation than a few names carrying the index. On money flow, big money is still moving in. Our internal reading, an approximation of whether institutional dollars are buying or selling based on weekly volume across the major ETFs, sits at 65 in the accumulation zone. That confirms what the price trend is telling you. The foundation under this rally has not cracked. On the stock Beaver sentiment composite, the crowd is neither greedy nor fearful. The reading sits at 56, neutral. What pushes it higher is momentum and breadth, both in the low 60s. The VIX fear index sits near 21, calm enough to encourage risk-taking but not so low as to signal complacency. The safe haven pillar pulls hardest in the other direction at 44. Investors are not exactly flocking to bonds and gold for protection. And compared to a year ago, when this index sat near 82, sentiment has cooled considerably. That cooling is actually healthy. A market that climbs while sentiment falls is one where expectations have not gotten ahead of reality. If you are not a trader, the one thing to watch this week is whether financials, the most extended leader on the board, start to cool. How the market's hottest sector handles a pullback will tell you whether this rotation has legs or is getting tired. Top stock picks. Let's start with the buy signal radar, our mechanical screen for stocks in active bull trends. Right now, roughly 148 stocks are flashing buy signals. That's a broad, healthy tape. The longest streaks belong to a cluster of names with 3 consecutive days on buy. HP Inc., ticker HPQ, stands out because it also appears in our momentum rankings. We call that high confluence. The mechanical signal and the performance ranking agree. Lockheed Martin, Nucor, Packaging Corporation of America, Quest Diagnostics, RTX, General Motors, Allegion, and Smurfit Westrock also carry 3-day streaks. Among the 2-day signals, high confluence names include Garmin, ticker GRMN, Willis Towers Watson, Workday, Baxter International, IQVIA Holdings, and Global Payments, all flagged on both the buy side and in our momentum or swing rankings. When 2 independent systems point the same direction, that tells you a move has structural support, not just a one-day bounce. Now let's look at what's hot this week. The standout name is Garmin, ticker GRMN, up 23.9% over 7 days and 47% year-to-date. The catalyst is fresh and specific. Garmin just reported second quarter revenue of $2.2 billion, up 11% year-over-year, driven by fitness wearables, marine, and aviation growth. Operating income climbed 30%. Management raised its full-year 2026 outlook, and the stock promptly hit a new 52-week high. When a company beats estimates and lifts guidance in the same print, that is the kind of catalyst that turns an existing trend into a genuine breakout. Garmin also ranks among our best 180-day performers at 43.8%, so this is not a flash in the pan. The stock has been building for months and just received fresh fuel. Workday, ticker WDAY, sits right behind Garmin with a 23.6% weekly gain. The stock recently crossed above its 200-day moving average, a technical milestone that often marks a shift in long-term sentiment. Workday also announced a partnership with EarnIn to bring enhanced direct deposit tools to millions of workers across its platform of more than 11,500 organizations, including over 65% of Fortune 500 companies. That extends Workday's reach beyond core HR and finance into everyday financial services, a meaningful ecosystem expansion. It is worth noting that Workday is still down about 23% year-to-date, so this week's surge has the flavor of a recovery trade rather than continuation of an existing bull run. Baxter International, ticker BAX, is our third hot name, up 23.4% over 7 days. Baxter posted second quarter earnings of 56 cents per share against consensus estimates of 36 cents, a substantial beat, and raised its 2026 guidance. The CEO cited both core operating momentum and a tariff refund benefit. What makes Baxter especially compelling is the confluence. It is not only surging this week, but also up 37% year-to-date and nearly 35% over 6 months. When you see a stock leading on both the short-term and the multi-month timeframes simultaneously, the underlying business is genuinely inflecting. The 3-month gain of 55% tells you institutional buyers have been accumulating steadily, not just chasing a headline. On the swing and recovery side, Accenture, ticker ACN, has rallied 17.7% this week. Accenture has been building real momentum in AI consulting. The company recently collaborated with Radisson Hotel Group to launch an AI-powered hotel discovery experience embedded directly in ChatGPT. That is exactly the kind of tangible, revenue-generating AI deployment that enterprise clients will pay for. Adobe, ticker ADBE, is up 16.8% over 7 days as well, showing recovery signs after a difficult year. Adobe is still down about 32% over the past 12 months, but the recent action suggests buyers are finding a floor and pushing back. Willis Towers Watson, ticker WTW, also reported this morning. Second quarter earnings of $3.35 per share beating estimates of $3.13, with broad-based organic growth and margin expansion driving the beat. The stock is up over 28% this past month, one of the cleanest accelerating trends on our list. Now let's shift to the big picture winners, our best 180-day performers. Datadog, ticker DDOG, stands alone at the top, up 108% over 6 months and nearly 101% year-to-date. Datadog is the cloud observability platform that companies rely on to monitor their infrastructure. And as AI workloads multiply across cloud environments, the demand for monitoring grows right alongside them. Datadog has an impressive earnings surprise history, and it recently announced a partnership with Cloudaware to close gaps in cloud log coverage. The stock gained another 9.9% this week on top of that enormous run momentum that refuses to fade. Stanley Black & Decker, ticker SWK, is up 25% year-to-date and 20.7% over 6 months. The company just beat second quarter estimates on significant margin expansion, adjusted gross margin improved by 620 basis points year-over-year, and raised its 2026 outlook. Strength in the U.S. tools business and commercial channels drove 3% organic growth, offsetting weakness in outdoor products. This is a classic turnaround where cost discipline and operational improvements are finally translating into earnings power. The industrial sector more broadly has been firing on all cylinders this earnings season, which reinforces the tailwind behind names like Stanley. Baker Hughes, ticker BKR, up 27% year-to-date, deserves attention as well. The company just secured a major order for 76 industrial gas turbines from Dynames Power Solutions, roughly 1.3 gigawatts of power generation capacity, earmarked for data center and oil and gas applications. That is a direct pipeline from the AI infrastructure boom to Baker Hughes' order book, and it validates the company's pivot toward energy technology. HP Inc. rounds out the 180-day leaders at 35.6% over 6 months, riding a strong, accelerating uptrend with one of the cleanest trend profiles on our entire list. A quick smart money side note before we move on. Across our picks today, shorts are mostly behaving, no extreme builds or covers that would suggest these bullish moves are being faded by bears. That matters. When short interest is quiet during a rally, the upside tends to be cleaner and more durable because there is no large constituency fighting the tape. If short positions begin building on any of these names in the coming weeks, that would be worth watching for potential squeeze dynamics. But for now, the path of least resistance appears to be upward, and the bears are not standing in the way. Top ETF picks. Our buy signal radar is packed today, with more than 100 leveraged ETFs flashing active buy signals. 3 names carry confluence tags that mark them as high conviction, meaning they appear on multiple internal watch lists at once. PATX, the Trader 2X Long Path Daily ETF at $9.96, shows up on both the buy signal radar and our momentum screen, with 3 consecutive buy days. NOWL, the Granite Shares 2X Long Now Daily ETF at $5.69, carries the same dual flag. And CURE, the Divergence Daily Healthcare Bull 3X ETF at $126.52, appears across both signal and leveraged rankings. Now, a critical reminder before we go further. Leveraged ETFs use derivatives to amplify returns and losses. They're for short-term trading only and decay if held long-term. Keep positions small and have an exit plan. These are short-term trading vehicles, not something to buy and hold in a retirement account or with money you're counting on. The hottest corner of the market this week is enterprise software, and it's not close. The 7-day leaderboard tells the story. PATX, the 2X Path Fund, surged nearly 45%. NOWL, tracking ServiceNow at double leverage, climbed 40%. MSFU, the Microsoft Bull Fund, rallied 37%. And SBOG, leveraged to Spotify, gained nearly 23%. What ties these together is the AI-driven enterprise spending cycle. Companies are writing real checks for automation and cloud infrastructure, not just running pilot programs. NETG, the 2X Long Net Daily ETF at $17.51, rounds out the software theme with a 16% weekly gain and nearly 70% over 6 months. This isn't a one-week pop. The enterprise software momentum has genuine staying power. In the swing and recovery category, the China story stands alone. YINN, the Divergence FTSE China 3X Bull Fund at $32.47, is up 18.5% this week with a strong accelerating trend. According to Invez, the Hang Seng has rebounded nearly 14% from its lows this year, even as the Nikkei and Kospi have fallen sharply, 15 and 40% respectively from their highs. That divergence is striking, and it's drawing real money. KJD, the 2X long JD ETF at $22.5, jumped nearly 15% this week, and an eye-popping 57.7% over the past month. CWEB, the China Internet 2X fund at $24.56, added nearly 14% with momentum accelerating. EURL, the 3X Europe Bull Fund at $49.54, gained 11.6% this week with positive returns across every timeframe we track. So the international recovery trade is broad, not limited to China alone. Now to the year-to-date leaderboard, where energy is the champion by a wide margin. NRGU, the microsector's big oil 3X leveraged ETN at $43.75, leads the entire leveraged ETF universe with a 136% gain year-to-date and 98% over 6 months. Gush, tracking oil and gas exploration and production companies at double leverage, is up 71% on the year. Today's headlines explain the bid. Reuters reports a drone strike damaged 2 gas tankers in Egyptian waters near the Suez Canal, renewing security concerns about a vital Saudi oil export route since the Iran conflict began. Portugal just approved a 33% windfall tax on oil company profits tied to that same price surge. WTI crude is finding support near $78.56 per barrel. XOMX, the Exxon 2X Bull Fund at $45.32, carries the highest technical composite on our leverage board with a golden cross and rising momentum. For income-focused investors, SCDL, the ETRACS 2X leveraged U.S. dividend factor ETN at $57.20, is up 42% year-to-date with a golden cross intact. And AAPU, the Apple 2X fund at $45.83, continues its strong run with a one-year gain exceeding 100%. Now let's look underneath these price moves at what short sellers are doing. The latest FINRA Reg Show data shows GEMG topping the highest short percentage panel at 99.8% of daily volume, followed closely by TDCL at 99.7%. TDCL is the 2X long TDC fund that appears on our buy signal radar, so that overlap is worth flagging. AIQD, an inverse AI fund, sits at 96.2% short volume, and heavy shorting of an inverse fund is effectively a bullish bet on artificial intelligence underneath. Now, most short volume and leveraged ETFs is intraday market maker plumbing, not directional bets. The signal matters at the extremes, and especially when a name from our own watch list shows up near the top. Hedger activity across our leveraged ETF picks is broadly normal this week. TDCL's extreme reading on the short volume panel is the one outlier worth monitoring if that name is on your radar, but there's no major shorting or short covering signal across the rest of our picks. The technical setups we discussed stand on their own merits. Today's short volume data is supplementary color, not a contradiction. Consider it background context as you weigh any of these themes, and remember that leveraged products demand discipline, small positions, and a clear exit plan. Options activity and setups. Now let's flip to the options market. First, what the broader tape is telling us about fear and dealer positioning. Then we'll bring that read back down to the individual stocks on today's pick list. The simplest mood reading in options is the put-call ratio, or PCR. Calls are bets a stock goes up, puts are bets it goes down, or insurance against a drop. When the ratio sits above 1, traders are buying more puts than calls. That is a cautious signal. Today the aggregate PCR across the big 3 ETFs SPY, QQQ, and IWM is 1.15. In plain terms, traders bought about 15% more downside bets than upside bets. The mood label on our internal pipeline reads cautious. Small caps in the IWM are the most nervous, with a PCR of 1.40, while the large cap SPY sits at 1.11. Nothing screams panic, but the tilt is clearly defensive. Now look at the 25 delta skew on SPY. That is the cost gap between out-of-the-money put insurance and out-of-the-money call lottery tickets. Today that gap is 4.2 points, which our pipeline tags as low fear. Crash insurance is almost as cheap as an upside lottery ticket. So the PCR says cautious, but skew says calm, mixed signals. Traders are buying protection, but they are not paying up for it. That combination often means routine hedging, not outright fear. Now to the market makers, the dealers who sell us most of these options. Their hedging either calms the tape or amplifies it, and the key metric is gamma exposure, or GEX. When dealers are net positive gamma, they act like a shock absorber, buying dips and selling rallies, which dampens volatility. When they are net negative gamma, they become an amplifier, selling into weakness and buying into strength, which supercharges every move. Today the 3 major indices are telling different stories. SPY is in amplifier mode with net gamma at about negative 8400, and spot at 741.74 sits just below the gamma flip price of 747.30. That flip is the level where dealer behavior switches. As long as SPY stays below it, moves get magnified. Small caps in IWM are in even deeper amplifier territory, with net gamma at about negative 48,500 and spot well below its flip at 305. But QQQ tells the opposite story. Dealers there are net positive gamma at about 9,600, meaning the tech-heavy index has a shock absorber underneath it. QQQ is sitting above its flip at 657.71, and max pain sits at 690, which can act like a magnet pulling price toward it into expiration. The takeaway: large cap tech is pinned and dampened, while the broad market and small caps are set up for sharper swings if any catalyst hits. Shifting to sector volatility. Implied volatility is what the options market expects a stock to do. Realized volatility is what it actually did. When implied runs well above realized, traders are bracing for something. The richest sector today is utilities XLU, where implied vol is 1.5 times realized. Materials, ticker XLB, is close behind at 1.42, and energy, XLE, sits at 1.36. When defensive sectors like utilities carry the richest option premiums, that often signals a broader risk-off undercurrent, money positioning for safety. On the cheap side, consumer discretionary XLY has an IV-to-HV ratio of just 0.68. Options are pricing in less drama than the sector has actually delivered. Semiconductors, SOXX, are also cheap at 0.76, and real estate, XLRE, at 0.84. The semiconductor reading is especially interesting given the AI capex narrative driving that group. Complacency, priced into options, while the underlying stocks have been swinging wildly. Now to unusual options activity, where we look for heavy volume that signals fresh positioning. Three names stand out with confluence, meaning they also appear in other parts of today's show. Microsoft, ticker MSFT, shows heavy call buying with a put-call ratio of just 0.24. That is overwhelmingly bullish, roughly 4 calls for every put. About 54% of its standing open interest changed hands today, so this is fresh positioning, not just routine roll activity. And Microsoft also appears in our house trading segment, that is double confluence. Nvidia, ticker NVDA, at $195, shows a put-call ratio of 0.28 with a bullish skew flag. Nvidia also shows up in our Senate trading segment, another double confluence name. When unusual options flow aligns with congressional buying, it adds a layer of confirmation worth noting. On the bearish side, IWM, the small cap ETF, has a put-call ratio of 6.2, meaning roughly 6 puts traded for every call. That is a heavily defensive stance, consistent with the amplifier mode gamma we just discussed. For listeners running a covered call strategy, where you own shares and sell call options against them for income, a few names stand out today. Western Digital, ticker WDC, is pricing implied volatility of 120% with an IV rank of 74, meaning volatility is elevated compared to its own history. The call 15% above the current price is pricing roughly 93% annualized. Intel, ticker INTC, also shows up at 103% implied vol with an IV rank of 57, pricing about 70% annualized on that same structure. These are high beta names. The premium is rich because the stocks move that much. A covered call caps your upside on exactly the rallies that would rescue a drawdown, so size accordingly. Corning, ticker GLW, rounds out the list at 95% implied vol with an IV rank of 66 and about 56% annualized on the 15% out call. Now let us bring that backdrop down to our picks, specifically, wherein today's stock list does options positioning also argue for higher prices. We pre-filtered the pick list to just 2 names, one via clear bullish positioning bias, the other via the strict gamma squeeze checklist. The scorecard shows only the picks where options activity is leaning bullish. Neutral and bearish names were dropped upstream so we do not waste time on them. Each row carries a squeeze phase label. Pre-fire means a coiled spring. Mid-fire means the amplifier is on. Late means the move is mature. Long gamma means dealers are running a dampener. Today we have a mixed picture, one name in a neutral waiting posture, the other in what our pipeline calls a trigger zone, meaning a regime change is imminent. Let me walk you through the framework. A real gamma squeeze setup needs 4 things at once. The stock trading below its gamma flip so the amplifier is switched on. Gamma exposure that is actually negative. A call wall 3 to 15% above the current price to provide runway, and a put wall in the same zone below to act as a floor. Think of it like a coiled spring. The floor keeps it from collapsing, The ceiling gives it room to expand, and the amplifier underneath means any push gets magnified. The rank 1 candidate is Stanley Black & Decker, ticker SWK, at 95.55. It passes all 4 checks. Spot sits below the gamma flip at 98.68, meaning the amplifier is on. There is about 4.7% of runway up to the call wall at $100, and a put wall at 90 provides roughly a 5.8% cushion below. The squeeze quality score comes in at 61, with its strongest marks coming from runway and floor structure. Quick contrast, Apple, ticker AAPL, at 333.43 does not pass the strict gamma squeeze checklist. Specifically, spot is above the gamma flip at 324.2, which puts it in a long gamma or dampener regime rather than amplifier mode. But positioning still tilts bullish. The upside score of 59 well exceeds the downside score of 47. Different reason, same direction. Starting with SWK at 95.55. Dealers are in amplifier mode. The gamma flip sits at 98.68 and spot is below it, so any move gets supercharged by dealer hedging. The next level to watch is the call wall at $100. That is where dealer hedging would slow a rally, acting like a ceiling. The put wall at 90 is where dip buyers tend to show up. Earnings are 96 days out, so this positioning read holds for a while. Now Apple at 333.43. The gamma flip sits at 324.2 and spot is above it. Apple is currently in dampener territory, meaning dealers are absorbing moves rather than amplifying them. But the squeeze phase reads trigger zone, regime change imminent. A small push could shift the structure. The call wall at 345 marks where a rally would hit resistance, and the put wall at 300 provides a floor. Heads up, Apple reports earnings today, so this entire positioning picture resets after the print. Whatever structure exists now gets wiped clean by the numbers. Diving deeper into the mechanics. SWK first, the standout metric here is the put-call volume ratio of 13. That is extreme. For every one call that traded, roughly 13 puts changed hands. That sounds bearish on the surface, but in a stock where total option volume is thin, only about 2,100 put contracts, a handful of large trades can skew the ratio dramatically. The net gamma is negative at about $258,000, which confirms the amplifier setup. Implied volatility sits at 38.5% versus realized of 42.3%, so options are actually cheaper than the stock's recent moves. That is fair value, not rich. Now Apple, and the number that jumps off the page is implied volatility at 67.8%, which is double the realized volatility of 33.4%. That ratio of 2.0 means option premiums are extremely rich heading into earnings. For anyone thinking about buying options on Apple right now, you are paying top dollar. The market has already priced in a massive move. The more interesting signal is the call skew at negative 16.4%, which means upside call premiums are unusually bid. Traders are paying up for calls bets on the stock going higher, rather than just loading up on protective puts. With earnings tonight, this is a binary event where positioning is secondary to the actual results. Remember, this whole segment is positioning context, not a trade idea. A picks list with a gamma tailwind underneath it is a higher quality setup than one without. That is the only claim. With that backdrop locked in, let us see what Congress was doing this week. Congressional Trading. No new congressional trades hit the disclosure filings over the past 3 days, so today we're focusing on the broader 30-day pattern across both chambers. The overall signal from Capitol Hill is net buying. Lawmakers have been accumulating more than they've been selling. The most striking pattern is a split between the two chambers on a couple of well-known names. Senate filings show United Health Group, ticker UNH, as the top buy, 2 senators adding shares, even as the House logged 3 separate sales of the same stock. Same story with Alphabet, ticker GOOGL, 1 senator buying while House filings showed 4 sells and 0 buys. When the two chambers move in opposite directions on the same stock, it's worth noting. On the House side, S&P Global, ticker SPGI, saw the heaviest activity with 8 total trades, and Hubbell, ticker HUBB, drew 6 buys with no sells. Stepping back, the Senate filed 131 trades over the last 30 days, 96 buys against 34 sells. The House was far more active at 360 trades, split 202 buys to 158 sells. Both chambers lean buying, though the Senate's ratio tilts more decisively toward accumulation. The Senate was also shedding Apple and Procter & Gamble, 2 classic defensive names, while the House trimmed positions in Live Nation, Nokia, and ExxonMobil, ticker XOM, ahead of its expected Friday earnings report. Insider activity. Not a single stock this week drew cluster buying, meaning no company saw multiple insiders purchasing shares simultaneously, and that absence is itself a signal. The broader mood reflects the silence. Over the past 14 days, insider buying has run at a ratio of just 0.215 purchases against 694 sales. The most concentrated buying is at Elevance Health, ticker ELV, where two insiders made three purchases totaling about $1.37 million. Beyond that, McCormick, Northern Trust, and Texas Pacific Land each saw modest buys under $60,000. Selling dwarfs all of it. Phillips 66 alone accounts for over $7.4 billion, but most of that reflects routine diversification and tax planning rather than any verdict on the underlying businesses. Outside the major indices, the conviction reads differently. Angeliki Frangou, CEO of Navios Maritime Partners, ticker NMM, committed $846.8 million to the shipping partnership, even as the company just declared a modest $0.6 quarterly distribution. Sumitomo Mitsui Financial Group poured $318.7 million into Jefferies, ticker JEF, deepening a cross-Pacific banking alliance. And Prudential Financial invested $60 million in the PIMCO Dynamic Growth Fund, ticker TYG. These are concentrated, 8- and 9-figure bets by buyers who know these businesses intimately. And when insiders deploy that kind of capital with their own money, it is worth paying attention. Federal budget. Through July 29th, the government collected $341 billion in net receipts and spent $587 billion. That $246 billion monthly deficit is essentially flat versus last July. And flat here is the story, because it means nothing is bending the curve. Gross receipts were $353 billion, but $12 billion went straight back out as refunds, a reminder that even the money coming in is partially circular. Health and Human Services led spending at $199 billion month to date. Social Security followed at $130 billion, and the line that should worry everyone, interest on the public debt, now exceeds the entire defense budget on a fiscal year basis. When your borrowing costs outrank your military, the composition of the budget has fundamentally shifted. A single day saw $2.2 billion go out the door for Medicaid grants to states, routine, but emblematic of how quickly the numbers stack up. Zoom out to the full fiscal year. The government has collected $4.8 trillion and spent $6.1 trillion, a $1.27 trillion cumulative deficit that is actually 7.3% better than last year. But here is the catch. Better still means we are on pace for a $1.8 trillion full-year deficit. The structural gap is unmistakable over the decade. Outlays climbed from roughly $4 trillion to over $6 trillion, and that post-COVID elevated baseline never came back down. Meanwhile, annual interest costs are on a relentless march. $1.15 trillion in 2024, $1.27 trillion projected for 2025, and a pace of $1.39 trillion this year. That is a $240 billion increase in just 2 years, purely from higher rates rolling across the debt. That trajectory leads directly to the debt itself. The national debt stands at $39.8 trillion. To make that real, that is $119,000 per citizen, $265,000 per taxpayer, numbers that feel abstract until you realize every American's theoretical share exceeds the median home price in many cities. The pace is accelerating, and that is the most alarming part. The jump from $38 trillion to $39 trillion took just 4.8 months. Each new trillion arrives faster than the last. At this growth rate, $50 trillion arrives by mid-2029. Measured against the economy, debt to GDP sits at 123%, well past the 100% reference line that historically signals fiscal stress. The United States last saw these levels after World War II, but this time there is no post-war demobilization to bring the ratio back down. Who holds the debt? Private domestic investors own the largest share at $27 trillion, roughly 68%. Foreign investors hold $9.3 trillion. Japan leads at $1.14 trillion. The UK is second at $949 billion, and China has been steadily reducing its exposure, now down to $659 billion and falling. That geopolitical shift matters. The second largest economy in the world is quietly stepping away from financing U.S. debt. The average rate on marketable Treasury debt has climbed from roughly 2.9% in mid-2023 to 3.4% today. Apply that across $30 trillion plus in marketable securities, and you get the annual interest tab that now exceeds the entire defense budget. But here is the real trap. Of roughly $31 trillion in marketable debt, about $7.4 trillion, nearly 24%, reprices within 12 months. Every 25 basis point increase adds $18.5 billion in annual interest costs. A full percentage point adds $74 billion straight to the deficit, which adds to the debt, which means more interest next year. The government has financed itself with an adjustable rate mortgage. That worked when rates were near zero. It is a very different equation now. Week ahead. This is a packed stretch for earnings, with 10 major companies reporting across just 3 sessions. Tomorrow morning brings the energy giants, ExxonMobil, ticker XOM, and Chevron, ticker CVX, both reporting before the bell, along with ABVI, ticker ABBV. Those oil majors arrive with crude finding support near $79 a barrel amid overseas supply disruptions, so their numbers will be closely watched. ABVI gives us a read on whether pharmaceutical pricing power holds up in this rate environment. Tuesday, August 4th, is the heaviest day. Advanced Micro Devices, ticker AMD, reports alongside Caterpillar, ticker CAT, and together they tell you a great deal about where the AI spending boom and industrial demand actually stand. Pfizer, Merck, and McDonald's round out that day's major reports, giving you healthcare and the consumer in a single session. Then Wednesday, August 5th, brings Eli Lilly, ticker LLY, and Disney, ticker DIS. Lilly has been a standout in pharma, and Disney offers a window into whether consumer spending on experiences still holds up when mortgage rates are at one-year highs. Beyond those headlines, Monday features Palantir, Gilead Sciences, and Marriott. Tuesday adds Arista Networks, Amgen, and Western Digital. Wednesday includes CVS Health, Uber, and Shopify. The breadth here, industrials, healthcare, semiconductors, consumer discretionary, makes this one of the most informative stretches of the entire earnings season. Now to the economic calendar, where 3 high-impact releases anchor the week. Monday's ISM manufacturing PMI comes in at a previous reading of 53.3, expected to hold near 53. Tuesday brings JOLTS job openings, previously at about 7.6 million, with consensus near 7.3 million. A further cooling in labor demand would matter for anyone watching the Fed. Wednesday rounds it out with the ISM Services PMI, previously at 54. Services is the bigger slice of this economy, so that reading carries real weight. Also landing tomorrow, the Employment Cost Index for the second quarter, expected at 0.8% quarterly. With the Fed's inflation credibility under scrutiny, that wage data matters more than usual, and the OPEC meeting on Sunday could set the tone for oil into Monday's open. On the IPO front, 2 operating companies debut Friday. Upnamed, ticker APMD, a late-stage developer of an oral treatment for sleep apnea, targets a valuation of about $608 million. And TP, the global business services provider formerly known as Teleperformance, lists on the New York Stock Exchange. It is a full docket, earnings, inflation signals, and manufacturing data all landing within days of each other. I will be right here walking you through every key release as it happens. As we near the end of the podcast, the key takeaways are these. The bond market's open defiance of the Fed is the story of July, the 10-year yield at 4.67%, while the central bank holds steady signals investors no longer trust that inflation is under control. Watch next week's ISM manufacturing and JOLTS job openings data for confirmation of the slowdown credit markets are already pricing in. For interactive charts and all the numbers behind today's discussion, visit stockbeaver.com. Thanks for listening. I'll see you tomorrow.